Well, good morning everyone, and thanks for getting up so early on a beautiful Perth morning to join me. By the time we're done, you may well wish you'd stayed in bed, but I'm afraid the good folks at ASFA rather foolishly told me to pull no punches, so with the caveat firmly in place that they told me to do this, off we go. The theme for this year's conference is not over the rainbow, but rather beyond the horizon, and as a wise man once said, in order to try and understand what's beyond the horizon, we must first understand what lays behind us. So before we try and peer into the future, we're going to take a look in the rearview mirror to understand how we came to be where we are today. Now, any presentation that begins with poor sweet Dorothy being turned into a wizened old hag can surely only get better, but I'm afraid that isn't necessarily the case in this particular instance. Among my briefing notes for the conference was a phrase which resonated strongly with me: think different. Upon reading those words, my mind immediately turned to a series of ads that ran in the 1990s for a small upstart computer company called Apple. The ads featured visionaries who changed the world through the actions they took in the normal course of their everyday lives. Whether it be boxing, music, filmmaking, or sticking your hand up a frog, these pioneers changed the lives of millions. By thinking differently, Steve Jobs and his colleagues managed to somehow, briefly, create the biggest company the world had ever seen, while somehow simultaneously maintaining an image of being the plucky underdog. It was sheer brilliance. Today's financial world is driven by a different group of geniuses, central bankers, and the current crop has been forced to think more differently to any who've held the office before them, and the creativity of their thinking has ramifications for everybody in this room. Those Apple ads of the late 1990s could have been written for today's central bankers, the crazy ones. Like Apple's target demographic, Draghi, Kuroda, Carney, Bernanke and the rest of the gang aren't fond of rules, and they too have no respect for the status quo. They are quoted, disagreed with, glorified by politicians, and vilified by many market professionals, none more so than me, I'm more than willing to admit. But the one thing they cannot be is ignored. They have changed everything, and I'm afraid in ways that will ultimately end in disaster.
Forever blowing bubble, pretty bubble, no more trouble, pretty bubbles in the air.
Yes, after an extraordinary period of coordinated loose monetary policy in all the world's largest economies, we are now near the popping point of the third great bubble of the last 15 years, each one bigger than the last. The tech bubble was kick-started by a short period of low rates, which Alan Greenspan instituted after long-term capital management almost went to the wall, all in the name of saving the system, of course. Next up, the maestro blew an historic housing bubble by holding rates far too low for far too long, between 2002 and 2004, to try and stave off a recession. Genius. The bursting of that bubble led to the unprecedented central bank action and the unfathomable market conditions we face today, and has caused an epic bubble in government debt that, when it inevitably bursts, will cause problems of a magnitude far greater than those we saw in 2008. And now, of course, we are about to enter the Janet Yellen era. And poor Janet is going to have to somehow try and find an even bigger bubble to blow when this latest one bursts, if she's not to be the one at the helm when this ship finally goes down. I have my doubts that she'll be able to find one, though. But what are the knock-on effects of central bankers' actions? Are they working? And most importantly, how does it affect the way in which we will have to invest for the next few years? In an attempt to explain what quantitative easing does to a group of wealthy American investors about a year ago, I put together this simple slide to explain to them why they suddenly didn't feel wealthy anymore. And I have to say it worked beautifully. It also happens to explain the purpose of, without any shadow of a doubt, the biggest factor anyone trying to invest capital has had to deal with over the last several years: quantitative easing. QE has been lauded as the saviour of the world, but now, like Frankenstein's monster, it's taken on a life of its own. And as we've seen in recent months, as talk of the taper wobbled markets, the geniuses who gave this thing life just can't bring themselves to kill it. That's a huge problem which, like the monster itself, is only going to get bigger and more dangerous. Make no mistake about it, looking beyond the horizon, quantitative easing is and will continue to be the single biggest influence on every investment decision you're going to be making, possibly for several years. But it didn't used to be this way. The vast majority of us in this auditorium today have spent our careers in a world of traditional risk and asset allocation models, when alpha could be generated by smart managers, and traditional methods of both overall allocation and bottom-up asset selection learned over hundreds of years of economic history could be relied upon to generate performance within defined and wholly acceptable risk parameters. It was a very safe environment, give or take a few hiccups along the way, obviously. And the asset allocation industry, at least the traditional part of it represented here today, likes safe. It likes predictable, because those are the sorts of steady, consistent returns that allow pension funds planning for the longer term to compound and match their liabilities to their funding. Lovely. What we've witnessed for the last 30 years is essentially a one-way bull market in equities, corporate bonds, and government bonds, not to mention real estate and commodities. Sure, there were hiccups along the way, 1987, 1999, and obviously 2008 being the ones everybody remembers, but essentially, particularly in the safer confines of the bond market, where shakeouts have been fewer and far less dramatic, as you can see here, a buy and hold strategy has worked remarkably well, but only as long as your time horizon was sufficient. Now, however, we've reached the point where the bills have come due for those last blissful 30 years, and in a desperate attempt to avoid paying them and taking the consequential pain inherent in doing so, we are seeing the flip side of that confiscation of interest income we saw a couple of slides ago, as investors are forced into darker corners of the investment world in order to replace that which they've been relieved of by kindly central bankers. That's led to some obvious mispricing of certain assets, and we're not talking about esoteric assets here. We are talking, amongst other things, about bonds and equities. We've already seen the steady progression of bond and equity prices from bottom left to top right over the last 30 years, but let's take a closer look at where we currently stand. And we'll begin with government bond yields. This jumbled mess shows the yields on UK, Japanese, German, Canadian, French, and good old Aussie 10-year sovereigns. German bund yields, well, they're at all-time lows. Aussies, also all-time lows. UK gilts, well, as near as damn it, same thing. Folks, this is what a bubble looks like, period. How bad is the bubble in the government bond market? Well, this chart shows that the United States of America, with its $17 trillion deficit and its completely dysfunctional government, hasn't been more creditworthy at any point, seemingly, in the last 223 years. France, soon to be the new crisis in Europe and just recently downgraded by S&P, has never been able to borrow money more cheaply in 400 years of recorded history. And good old Great Britain, whilst not at quite the same extremes, is still looking at rates below which it hasn't been able to raise money in several centuries. And then, of course, God bless them, there's Japan. Currently, the Japanese government has a debt to GDP ratio of around 240% and public debts of 1 quadrillion yen. How much is that, I hear you ask? Well, if you wanted to count to 1 quadrillion, it would take you 31,709,792 years. Now, Kuroda-san, the newly installed Bank of Japan governor, has recently made investors a few promises. He promised to double the monetary base in 14 months, an extraordinary thing to do. He promised to create 2% inflation, and he promised, and I quote, to make JGBs as unattractive as possible. The result? Well, JGB investors initially seemed to get the joke, and rates started to rise quickly. But, of course, with debt servicing costs of $257 billion a year, which is a 14% increase in a 12-month period, the Bank of Japan simply couldn't afford for rates to go higher. No! So they stepped into the market to push those rates back down again, and they're now buying as much as 80% of their own issuance. So I ask you, at these prices, do these bonds, supposedly the safest on the face of the earth, look like they would represent only 10% of the risk in a traditional 60-40 portfolio? I don't think so either. So it must be time to rotate allocations from those overvalued bonds to equities. Except everywhere we look, they too are at nosebleed levels. The S&P 500 is making a series of all-time highs. Over in Europe, Germany's DAX index is doing exactly the same thing. How about emerging markets? Perhaps there's some value there we can rotate to find. Well, here's the Indian Sensex index. Yep, you've got it, all-time highs. Even in South Africa, the Johannesburg index is making a series of new highs, seemingly every week. And yet, all this is occurring against a backdrop of global growth that's essentially at the lowest level seen in the last 2 decades outside of the 2 major global recessions, despite trillions of dollars of stimulus applied in the name of creating growth. Everywhere you look, equities are at levels that would ordinarily scream to portfolio managers to take some money off the table and retreat into the safety of, yeah, you guessed it. Interestingly enough, there's one major market that is flashing red, and that's China, which is still 65% off its previous highs. You think that doesn't mean anything? Well, I'm willing to think it does, and I'm certain that we'll find out what at some point soon, but for now it remains a mystery. We, however, need to get back to the horizon we're trying to see beyond. And at this point in the proceedings, it's time to take a look a little closer to home and examine the predicament facing none other than the boy from the Shire himself, Glenn Stevens. Because in Stevens' predicament, lie lessons for ordinary investors about the unintended consequences forced upon us because of policy decisions. As far as being in predicaments, New York detective John McClane is in a class of his own. McClane is a tough cop who continually seems, through no fault of his own, it's important to add, to get himself into a series of nasty situations that seem impossible to get out of without there being the need for a massive clean-up operation. Here in Australia, one of the world's best central bankers is now finding himself backed into a corner from which it's hard to see a way out without some serious damage being caused. Over the past several years, Glenn Stevens has remained admirably independent and stuck to a policy that harkened back to the days pre-2008 when central bankers had something that used to be called credibility. However, Stevens now finds himself trapped in a Nakatomi Plaza economy where danger awaits him at every turn. And that begins with the strength of the Australian dollar. This chart shows the spread of the RBA cash target over the US Fed funds rate, and as you can see, Stevens had no qualms about allowing it to rise into the teeth of 2009 and beyond, just as the world's other major central banks were slashing their rates to zero. He did that because it felt like the right thing to do for Australia. Over the past 2 years, Stevens has changed his course dramatically, dropping the RBA cash rate to an all-time low of 2.5%. But a look at the differential between Aussie and US rates shows that, from a historical perspective, Stevens is still presiding over a far more attractive currency than just about any of his peers. That's had a predictable effect on the Aussie dollar, which strengthened to all-time highs. The trouble came when Stevens found himself needing to reverse the cycle and lower rates to weaken the currency again. By the time he started playing catch-up, the Aussie, which had until then responded beautifully to RBA interest rate policy, declined to play ball. Stevens had essentially lost control of his own currency, largely due to the actions of some of his less disciplined peers in faraway lands. Yippee-ki-yay, Aussie dollar. But it wasn't just interest rate differentials causing the unwanted strength in the Aussie. Australia's case of Dutch disease, the hollowing out of the manufacturing sector through the strong currency that comes with a booming natural resources sector, is hardly the first of its kind, as these other examples demonstrate, but it's just about the most severe on record, certainly in modern times. As large swathes of Australia have been dug up and stuck on boats bound for China over the last 15 years, the Aussie dollar has strengthened relentlessly to the point where both Sydney and Melbourne now sit comfortably in the top 4 on the Economist's annual list of the world's most expensive cities, behind Tokyo and Osaka, and ahead, amazingly, of places like Geneva, Singapore and London. The strength of the resource sector and the wealth it's attracted to this sunburned country has given Stevens a major headache. We've seen how the relative strength in the Aussie dollar has forced Stevens into cutting rates. But the flow of money into the country as a result of the resources boom has had a stunning effect on house prices, which are in a bubble, making that which burst so spectacularly in the United States back in 2008 look like nothing at all. Rates you would think would have to go up. But, unfortunately, if he did that, it wouldn't play well with Australia's rapidly rising unemployment rate. Then, of course, there's the omnipresent pressure of inflation, and that one could seriously go either way. Can Stevens cut rates again? Well, he certainly has room to against his peers, but that would just stoke inflation and add fuel to the fire already raging in the Australian housing market. So what can he do? Well, he can do what the other central bankers do when they're stuck or want to save some of their ammunition. He can try to jawbone markets. At a recent investment conference, Stevens made some extraordinary statements which showed a very clear intent. Central bankers don't use the word materially lower without good reason. In particular, that remarkable sentence was one which caught my eye. And surprise, surprise, it worked. But elsewhere in Stevens' speech were what card players refer to as tells. This sentence, which I'm sure Stevens meant as an assertion of future action by the Fed, seemed to me to be missing something. Surely the taper will come, Stevens said. Surely. But the biggest giveaway as to Stevens' desperate situation was this line. As Stevens implored the other major central bankers to begin the long journey home from Crazy Town, he seemed to be sending a subliminal message, which, if we rearrange the letters, comes through loud and clear. Stevens is in a bind. It's not necessarily one of his own making, but it's a situation that he, like us as investors, is being forced to deal with, and that means adjusting his own policy accordingly in response to the actions of Bernanke, Draghi, Kuroda, etc. But such adjustments can be very hard to come to terms with, and nowhere is that better illustrated than in the pension fund industry. The world that quantitative easing and central bank intervention has created is fraught for investors. But what does all this mean for those trying to figure out what's beyond the horizon? Well, in a word, decisions. Tough ones. Many pension funds refuse to stray from their projected returns, a lot of which are in the region of about 8% per annum, despite the fact that recent history demonstrates that going forward, this could be a deeply flawed expectation. Thankfully, there's a disclaimer for that. But so far, as the QE experiment continues, returns have been okay, but for all the wrong reasons, as the capital returns in bond portfolios mask the coming problem of yield destruction. That's led to many pension funds refusing to lower their targeted returns to more realistic levels because that would require some rather nasty conversations about the level of underfunding. To illustrate this, I'm going to turn to CalPERS, the California Public Employees Retirement System, and take a look at a move they made back in 2012. At the risk of preaching to the choir, CalPERS is the largest public pension fund in the United States and the fifth largest in the world. In July of 2012, it had a staggering $233 billion in assets under management, which was only enough to make it the fifth largest such fund in the world, but still. It was also underfunded by somewhere between 25 and 45%, depending on the measure you use. Now, traditionally, as many in this room will already know, 80% is the minimum assumed to be safe. In CalPERS' case, the small white disc in the centre of the blue disc representing the fund's liabilities shows the level of its funding. On March 12, 2012, CalPERS lowered their expected annual return from 7.75% to 7.5%. This was despite their own chief actuary advising them to lower it further to 7.25%. Why did they do that? Well, the catalyst was the announcement that their returns for fiscal year 2012 were 1%, a performance that put them below 99% of the big US pension funds. Now, granted, the fund had averaged 8.8% returns over the previous 20 years, but, as somebody once said, sadly, the magic of compounding works for evil as well as good, and it doesn't take long periods of underperformance for a fund that relies on the magic of compounding to fall woefully behind. If we are to enter a decade or more of significantly lower, perhaps even negative returns, as I fear we might, the gaps in funding for many funds will be gargantuan. Oh, incidentally, those assumptions were based on CalPERS being 100% funded. But I don't mean to pick on CalPERS. This is a far more endemic problem. In 2010, according to the NASRA Public Funds Survey that shows return projections against US state retirement plans, 8% returns were very much in vogue. 3 years later, things have changed a little, including the way NASRA brackets the assumptions, but 8% is still the favourite number by far. Despite lofty projections, though, and for the most part highly friendly markets as we've seen, funding levels have fallen by 25% in the past decade or so, a trend which, let's face it, with interest rates where they currently are, is only going to continue. This is another problem waiting to manifest itself once reality can no longer be ignored. But what is reality? Well, the reality of the situation we're facing right now is somewhat confronting, to say the least, and it's all thanks to the distortions that massive central bank intervention has created by the manipulation of supposedly free markets, all with the best possible of intentions, of course. Now, I'm sure that Benny and the Inkjets would, when looking at the definition there, choose the word shrewd over the word devious, but as we've seen from the way they've confiscated income from the most prudent of investors and coerced them into the inflation of risk asset prices, there is far more deviousness at play here than shrewdness, I'm afraid. It helps, of course, to have a complicit target audience. But what does that mean for the future? Well, let's go back to the beginning of this little journey along the yellow brick road and those traditional allocation models and see how they stack up in the current environment. You remember this, I'm sure. Well, if those are the lines along which you've been investing, then you're confronting an extremely interesting paradigm. Let's break it down. Your biggest single allocation, well, it's manipulated. As we've seen, thanks to QE, bond prices are at historical highs, despite the perilous state of both the world as a whole and the finances of the issuing authorities themselves. But never mind, that's a problem for another day. So what about equities? Well, they too are, in many cases, at all-time highs, purely and simply because of the promise of an ocean of freshly printed money that will be looking for a home every month for the foreseeable future. And while we're at it, we may as well throw in commodities, which are the final refuge for fiat currency when paper gains are exhausted. The zero cost of money ensures commodity prices remain artificially high. And all this brings me to the question that's undoubtedly on everybody's lips. Oh, hang on. There, that's better. So let's take a look at a few hard truths so we can figure out what might happen from here. The first thing to understand is this. The taper, it's not going to happen. Not in any meaningful way anyway. The Fed is completely trapped. Now don't get me wrong, the Yellen Fed may, and I emphasise the word may, make the mistake of attempting a mild reduction in the level of stimulus from $85 billion a month to say $65 billion a month, as Bernanke threatened to do in May, but if they do, they will very soon be forced into backtracking. The US economy is simply not strong enough to survive without massive stimulus. And besides, the taper isn't actually as big a deal as you might expect. This is the Fed's balance sheet projected out to 2015, assuming they continue buying their $85 billion a month in treasuries and MBS. And this is what it would look like assuming they tapered $20 billion a month. It's hard to see what the hell the fuss was all about, huh? Here's something else I know. If the Fed continues to try and force interest rates into negative territory, the $2.3 trillion, that's a staggering 50% increase in a single year, in excess reserves that's sitting idly at the Fed will pour into risk assets in search of positive returns, and that'll spark hideous inflation. Count on it. What else? Well, government bonds are in a bubble, period. Equity prices, well, they've completely disengaged from fundamental valuations. Market breadth, that's virtually non-existent once you strip out computer-driven trading. Our friends at the central banks, as we've seen, are out of bullets, and just about every government in the Western world is bankrupt. And finally, I know that there can be absolutely no winner amongst a group of fiat currencies who are in a competitive race to the bottom. But all this just begs the next question. Damn it. Hang on a second. There. What do we do now? Well, firstly, don't listen to me. There are far smarter guys than me who are screaming similar sentiments to those I've laid out today. So let's hear from them before I wrap things up. And we begin with Elliott Management's Paul Singer, who had this to say in a recent letter to investors. Singer's concerns, as always, are well-voiced and extremely accurate. But it's not only money managers who see these disconnects. Two CEOs of a couple of America's most favourite stocks recently scratched their heads in wonder at their own stock valuations. Tesla's Elon Musk and Netflix's Reed Hastings, neither of whom understand their own stock prices, and you'd think that they would know better than most as to what constituted fair value. Want the view of one of the savviest real estate investors in the world? Then look no further than Starwood Group's Barry Sternlicht, who pulled no punches in a recent interview. Folks, I don't think ugly is even going to come close. Jim Rogers, well, he was just as forthright recently, as he tends to be, and pay particular attention to those words. We're going to revisit those shortly. But the Kyle Sandilands Award for plain speaking definitely goes to Societe Generale's Albert Edwards, who calls it exactly as he sees it, and finishes this diatribe with 13 very important words. I'm going to give the final word, though, to Universa Investment CIO Mark Spitznagel, who in a recent interview told Maria Bartiromo that he felt the US equity market was set up for a 40% correction. For those of you who don't know Spitznagel, he achieved a degree of notoriety for calling the dot-com bubble, the 2008 crash, and the 2011 correction. And Spitznagel's advice is telling. Step aside. Step aside. Family offices have a huge advantage over traditional investment managers as they first and foremost try to protect their wealth. They are capable of taking a much longer term view, which might seem dangerous to some, but their primary concerns are not outflows. Now the Citigroup report referred to here completely misses the point in that first paragraph, because the reason these investors are going to cash is because they expect poor returns. The beginning of paragraph 2, however, is crucial. Family offices are moving their investments to cash fast, and for good reason. The risks of being invested are not commensurate with the potential rewards at these levels, period. So here's the thing. I began by talking about the need to think different, and never has there been a greater need to do that when allocating capital than now. But because of the massive manipulation of markets and the corruption of such basic pricing inputs as the risk-free rate by central banks and governments, not thinking differently has thus far worked. But not because it's prudent. Investors need to not only think differently, but think radically differently in a QE-shaped world, because traditional methods of investing no longer work. What does radically differently mean? Well, those traditional allocation models can be torn up for the next few years, I'm afraid. As an example, a portfolio that has 30% in synthesized bonds, and by that I mean assets that synthesize the cash flow but aren't yet anyway in the crosshairs of government QE programs, will likely outperform traditional bonds at these lofty prices. Things like real estate, assuming it's priced at fair value, something becoming harder to find as smart investors look for ways to replace the cash flows from their bond portfolios. Or productive farmland, which provides exposure to income streams from the one commodity that mankind will always consume, and that's food. And cash, plenty of cash. Be brave. Get out of markets now. Go to the maximum cash levels you're allowed by your mandates, and once you're there, lobby to have those limits raised. What we face is this. A horizon that's both impossible to see beyond with any certainty, and a world where decisions about capital allocation can mean opting to potentially miss out on continuing returns because they're powered not by fundamentals, but rather the pure force of central bank manipulation of everything, from the true cost of capital to bond and equity markets themselves. Or holding our noses and investing on that basis, even though it may run counter to everything we've learned throughout our careers. Personally, I don't like to play in games that are rigged, so I choose to sit out the next phase of the great experiment in search of an entry point that offers true long-term value, because I fundamentally believe that all the money you make is made when you buy something, not when you sell it. The good news is, once we get beyond the terrible shakeout that I fear lies just beyond the horizon, the landscape won't be so radically different to that with which we've become familiar over the years, as the impurities of quantitative easing are flushed from the system, and we can go back to investing in a world we understand. Right now is the time when the landscape is different, and it's right now when we have to think differently. Luckily, all the clues we need are to be found by looking backwards, not forwards. Eventually, a more familiar landscape will reassert itself. It always has, and it always will. History proves that beyond any doubt. History also proves that even though things seem so different today, we really have been here before. In fact, we were here in the late 1920s, almost exactly here. What happened next is only too familiar to most students of market history. That was a 48% correction. After her adventures in the fantastic land of Oz, all Dorothy had to do to return to the world with which she was so familiar was to click her heels together 3 times and say there's no place like home. Returning to a world with which we are familiar will require either some real magic on the parts of Messrs. Draghi, Kuroda and Carney, and of course soon Miss Yellen, or a tornado that sweeps away everything in its path and allows the world to build again from solid foundations. So what's it to be? More central bank conjuring tricks or the forces of nature? Folks, place your bets. Thank you very much.